This revision video covers all of monetary policy and financial markets, which is topic 7. We need to start with reminding ourselves about money. It's worth knowing some of the history of money to understand this stuff better, but what we need to know is firstly the functions of money, what money does. Good money, money acts as a medium of exchange, meaning it can be used to buy goods and services. It acts as a unit of account, meaning it can measure value. It acts as a store of wealth, meaning we can use it to store wealth, and it acts as a standard of deferred payment. Money enables payment to be made down the line. It enables borrowing to happen. Those first two functions, medium of exchange and unit of account, are more important. We also need to know what good money is like, what money's characteristics are. Effective money will be acceptable across an economy. It'll be durable. It'll be portable so we can carry it around. It's divisible so we can divide pounds into pennies. It's scarce, you can't just get it anywhere. And similarly, it's hard to forge. We can summarize that down into it being convenient to use, secure, and rare. It's convenient to use, it's secure, it's not going to break down, it can't be forged, and it's rare, so its value is consistent. We need to know the definitions of the money supply. Measuring the money supply is particularly important to monetarist economists. Narrow money refers to cash plus liquid bank accounts. And what we mean by liquidity is the ease of converting to cash, so liquid bank accounts to bank accounts where we can instantly withdraw our cash. Broad money is narrow money plus some illiquid assets. We don't need to worry about what those illiquid assets are, but that's a broader definition of money. We also need to know about the structure of financial markets. A few key terms to help us understand this. An asset is something that is owned by an individual or a bank, something that has value. A liability is something that they owe, money that they're going to have to go to somebody else. A portfolio is a collection of assets. Financial markets enable the trading of assets and liabilities. And when investors are putting together a portfolio of assets, they'll be considering three things: liquidity, how easily they convert it into cash; profitability, the returns on those assets; and security, how safe and how certain they are of the return on that asset. Generally, liquidity and security clash with profits. The most profitable assets are the least liquid and the least secure, but we need liquidity to make our payments, and we need security to minimize the risk we're exposing ourselves to. We'll come back to that trade-off in a moment. It's important we understand why financial markets matter, and then we'll overview how they fit together. Crucially, financial markets enable firms to raise funds. They can do that by selling shares in an initial public offering. They can do it by taking out loans from a bank, or by selling corporate bonds, which is the same idea. It's essentially borrowing money, but from other companies. And financial markets also enable insurance to happen, because insurance depends upon money being able to be borrowed. There are three different areas within financial markets that we need to know about. Firstly, we need to know about the money market, which is where loans between banks happen. Money is exchanged. We need to know about the capital market, which is where sales are sold. The primary capital market is where the initial sale of shares happened, the IPO, the initial public offering, usually organised by an investment bank. And the secondary capital market is the sale of shares after the IPO, the initial public offering, has happened. So that's the stock exchange, the London Stock Exchange, and there's various other ones you will have heard about. When we hear about stock prices, we're thinking about the price of stocks on the secondary capital market. We also need to be aware of the foreign exchange market, which is where investors and firms can buy and sell currency, which is obviously crucial for trade, more significant next year. There's the spot market, which is the immediate sale of currency, and also the forward market, or the futures market, which is where buyers and sellers agree on a certain rate for a future sale. Within financial markets, we also need to know about bonds in a bit more detail. We may need to do some calculations here, so we need to know the formula that the market yield on a bond is related to the annual coupon, the amount it pays each year, as a money figure divided by its market price. If we increase the market price of a bond, we're therefore decreasing its yield. Risky bonds or less liquid bonds will have a higher yield, and that's because they're in less demand if they're more risky or if they're less liquid. And that helps us understand the liquidity, profitability, security trade-off. The bonds which are most profitable will be, with the highest yield, will be the ones which are most risky or least liquid. We need to understand how banks fit together. And there's two types of banks. We're only going to look in detail at one. Commercial banks are also known as high street banks. They're the ones you see on the high street. They provide services to customers, firms and consumers. They take deposits, they issue loans, and they'll provide financial advice. Investment banks, normal customers don't interact with. They're also known as a merchant bank, but they provide services to institutions, big firms, other banks and governments. They trade in financial assets, they provide financial advice, and they'll also enable firms to sell shares. They'll organise initial public offerings. One key point here is the idea of systemic risk, which is the risk to the whole banking sector. So when one bank fails, how likely is it that the whole banking sector will fail? We want to avoid systemic risk because our total banking sector collapse would be catastrophic for the macroeconomy. When commercial and investment banks are joined and they're the same bank sharing money, there's a shared risk, increasing systemic risk in the economy. That is now not allowed in this country. They have to be separated even if they're owned by the same company. Banks create money using a process called fractional reserve banking. Here's the idea. Commercial banks receive deposits from consumers. Deposits are an asset because they've got cash, but also a liability because they're going to have to pay it back to the consumer. They'll keep a fraction of that deposit in reserve, but the cash they've got, they can now lend again. They can use that deposit to make a loan, and that loan will be credited to somebody as a deposit. So when they make that loan, they've effectively created new money. And now with that new deposit, they can lend more money. And the limiting point will be what they want to keep in reserve. So with a 10% reserve ratio, £1,000 of initial deposit can end up becoming £10,000 of deposits. They've lent £9,000 of money. And in that way, commercial banks effectively create the money supply. The amount they lend will be limited by a few factors. It'll be limited by the legal requirements placed on them, capital and reserve requirements. It'll be limited by the demand for loans in the economy, and it'll be limited by their confidence. If they're not very confident, they won't want to have lots of liabilities. They won't want to have. They'll want to hold a bit more back in reserve. Commercial banks' key objective is profits. They're a firm, but like we've seen, in order to achieve consistently high profits in the long term in the financial sector, we've also got to consider liquidity and security. Commercial banks will therefore hold a number of liquid assets that aren't very profitable in order to pay their ongoing obligations. And they'll have a number of more secure assets which also aren't very profitable in order to minimize risk. In order of liquidity, the assets we typically see a commercial bank holding are things like cash, bank reserves, bills and bonds, and long-term advances, loans to consumers and firms. The liabilities we likely see them holding, again starting with the most liquid, are things like the deposits that consumers have with them, the reserves firms have with them, which is the same idea but for firms, and then the debt that the bank holds, usually to other banks, short and long term. So how do we regulate this whole system? Well, that's where monetary policy steps in. Monetary policy is run by the central bank. In this country, that's the Bank of England. Its big aims are macroeconomic stability, primarily the 2% inflation target, and subject to that, other macro aims, but only if it can first achieve the 2% target. Its other big aim is financial stability, ensuring that the financial sector is serving the economy. There's a bunch of other things it does. The Bank of England acts as the bank for other banks and for the government, and it's responsible for managing the money supply and controlling the production of cash. We've got 4 policy tools that we need to be aware about, 2 really big ones. One is the base rate of interest, and that is the rate of interest paid by the Bank of England on the reserves that banks hold with them. It's really important to note it doesn't directly affect the macroeconomy. We need to understand how a change in the base rate affects the whole macroeconomy. And that is through the monetary transmission mechanism. A change in the base rate will affect aggregate demand, firstly because it will affect other market rates, because it changes the amount that commercial banks receive and therefore pay. It'll therefore affect asset prices, because if savings in a bank becomes more profitable, people will tend to sell other assets and save more, and vice versa, and that affects the price of assets, and therefore we get the wealth effect kicking in. If asset prices go up, the wealth effect means consumers will spend more. There'll be a direct impact on confidence. If the base rate of interest goes down, that will normally signal that the Bank of England is acting to expand the economy, which improves confidence. And it also has an impact on the exchange rate, because a low rate of interest causes foreign investors to be less keen to invest in this country or save money in this country, which means money moves out of this country, which tends to push up the exchange rate and therefore push up inflation. I beg your pardon, push down the exchange rate, push up inflation. The base rate of interest is set by the Monetary Policy Committee, which meets about 8 times a year. Bit of evaluation, there's some problems with it. It's obviously a crucial tool, but it's not perfect. The full effect of the base rate of interest takes about 2 years to come online. The effects can be uncertain, partially because of that time lag. And there's also the zero lower bound. In a crisis, sometimes we just can't drop it low enough. We're limited by the fact that we can't drop it below zero. Instead, sometimes the Bank of England turns to quantitative easing. And that's where the Bank of England buys assets from firms, not usually from commercial banks. That's different to traditional policies. Traditional monetary policies, like quantitative easing, usually involve buying assets from banks, so banks have more money. But if banks aren't willing to lend, then that normally isn't effective. So instead, the Bank of England purchases assets, normally government bonds, from firms. So firms have money to invest. The price of those assets goes up, causing the wealth effect. The yield on them goes down, causing investment into other assets, all of which ends up increasing aggregate demand. It does risk being inflationary if it's not controlled carefully, and it can have unequal effects because it's going to likely negatively affect those who have large savings. But these are relatively minor issues. 2 more minor policies. We need to be aware of funding for lending, which has now ended, but that was where the Bank of England lent at a very subsidised rate to commercial banks if they then lent those money on. So it's trying to incentivise banks to lend, particularly to small businesses. And forward guidance, which is where the Bank of England provides slightly clearer guidance on what they're planning on doing in the future to aid confidence. Lastly, we just need to talk about how the Bank of England manages regulating the financial sector. In the wake of the 2008 crisis, the structure of financial regulation was changed. There are now 3 key organisations. The Financial Policy Committee, like the Monetary Policy Committee, they're responsible for overviewing the whole banking system. That's called macroprudential regulation, particularly looking at systemic risk. They direct the PRA, the Prudential Regulation Authority, which is responsible for microprudential regulation, looking at individual banks. The Financial Conduct Authority is an independent watchdog that looks at the whole structure. It regulates the Financial Policy Committee, the Prudential Regulation Authority, and individual banks to make sure they're acting in a way which is fair and legal. In order to understand how we regulate the banks, we need to understand why they could fail, and there's 2 key ways banks could fail. They could fail firstly because they become insolvent, which is where their assets become too low to meet liabilities. So for example, if the value of certain assets suddenly falls and banks are quite leveraged, they've got a lot of liabilities, they can suddenly find themselves insolvent. The way we traditionally manage this is with a capital requirement, where banks are required to hold enough capital. And we're going to define capital. It's essentially the net worth of the bank, their assets minus their liabilities. Or another risk of failure is a bank run, which is where banks have insufficient liquidity to pay their deposits. And if depositors know that, there can be mass withdrawals, which can end up leading to the bank collapsing. And one way to manage this is with a reserve requirement. But a capital requirement will also limit it because banks hold a lot of capital as liquid assets. One more risk we need to be aware of is moral hazard. Because the Bank of England has guaranteed that it will back up banks in certain extreme situations, it might mean that some banks behave in a more risky manner because they know that they may be bailed out if they end up in crisis. That's called moral hazard, and it's a real problem when we design regulation. So regulation, which essentially boils down to these 3 organisations and capital or reserve requirements, has some pros and cons. The obvious advantage of regulation is that it makes the economy safer. A more regulated financial system bears less risk. But on the other hand, too much regulation is going to reduce profits in the financial system. And that could be a bad thing because it might mean there's less activity in the financial system. More finance means more investment. And so up to a point, more activity in the financial system is fantastic.